Hello everyone, welcome back to another video lecture. So today we're going to do a review session for exam number 3, which will be on Thursday, April 23rd, right? And I apologize for posting this video a little bit late. I did a video, I attempted to do the video yesterday, but somehow my internet really sucked. I failed to upload the video and I lost everything, so now I have to do it again. So in case you guys wonder why I haven't posted the review video earlier, I apologize. So alright, so let's see. So yeah, so exam 3, let's talk about exam 3, right? So exam 3 is going to be on Thursday, April 23rd. It's going to be 1 hour 20 minutes, right? So it's supposed to be 1 hour and 15 minutes, but I give you guys 5 more extra minutes, so in case you guys need it. So that's 1 hour and 20 minutes. And again, it's going to be available on Blackboard, and it's going to be at 1 p.m. on Thursday. And usually the exam is going to be available. It should be available sometimes around 12:50 p.m. Like around 10 minutes before the exam starts. The link should be available on Blackboard like last time. And in terms of the format of the exam, it's going to be similar to last time. It's going to be 30 multiple choice questions, and you guys have 1 hour 10 minutes to do it. And the format of the questions are similar to all the exams, all the prior exams. It's going to be conceptual questions, and they're going to be problems questions. So you are allowed to use a 3x5 note card in the exam, and also a calculator. So please, this is still a closed book exam, so you can only use the 3x5 note card. You cannot use any other items, any other materials to help you with the test. I know it's hard for me to proctor you, but I trust you guys. So alright, so for today's section, we just going to do I'm just going to go over some of the topics that I think you guys should pay more attention to, and we're going to go over a few practice problems. So I hope this exercise is going to help you with the test, and I think if you guys are able to do all of these problems, you should be fine with the problems questions on the exam. And some of you have told me that you kind of confused how to use the makers tables. So in here I prepare 2 questions to kind of guide you through how to use the tables, and I will provide the makers table in the test as well. So I think I'm going to send, I already have the makers table file here, and I think I'm going to send you guys this, so you can open this and use on the test. Alright, so let's start with our sessions. If you have any questions, just let me know. Just email me. Alright, so first let's go through a few topics that are important, that I want you to pay more attention to, because it's likely this topic is going to be asked on the test. So first of all, I want you to know the general requirements for business deduction. So the 3 criteria: ordinary, necessary, and reasonable, right? So ordinary and necessary just mean that the expense have to be, it has to be necessary for the exam to occur, in order for the business to make income, right? And then reasonable mean the amount cannot be extravagant. It has to be reasonable. It has to be suitable for comparable to other businesses. So I think in the lectures on chapter 9, I think we have 1 or 2 problems about the reasonable criteria, right? So I think later on we're gonna have another kind of problems. We have another problems to go through this. So I want you to pay close attention to how you can judge whether or not an expense amount is reasonable or not. Okay, all right. And next, I want you to know the limits on the business expense deduction. So there are several type of expense that are not deductible, right? So, for example, expenditure against public policy, right? So we know fine, bribery, money, right? Lobby expense, right? Or contribution to political contribution, pretty much, right? And then expenses relating to tax-exempt income, right? So remember, the interest expense, for example, interest expense on a loan that the taxpayer used to buy, let's say, municipal bond, right? So because municipal bond is a tax-exempt income, so that's why the interest expense on a loan that the taxpayer used to acquire the bond cannot be deductible, right? And we're gonna have a practice problem out there to go over this as well. So and then personal expenditures. So we know that personal expense cannot be deductible for business purpose, right? It has the expenditures have to be related to business purpose, so personal expenditures are not deductible, right? And then I want you to know how to calculate the deductible business expenses, related to transportation, lodging, meals, right? So and especially I'm going to ask you, let's say one person go on a business trip, and whether or not you have to be able to judge whether or not the business trip is a primary business purpose or it is a primary personal purpose. And then from there, I'm going to ask you to calculate how much of the expenditures does this taxpayer spend on the trip can be deductible, right? So remember, if the trip is the primary business purpose, then the transportation to the location, right, can be 100% deductible, right? Say airfare, fly to a location for business purpose, it can be deductible for 100% if the trip is primary business purpose, right? And then lodging can be deductible for the time that the taxpayer is engaged in the business activities, right? And then for meals, so only business meals are deductible, right? And the amount deductible is only 50% of the cost, right? So 50% of the cost of business meals are deductible, right? So we're gonna have another. We're gonna have problems, practice problems out there, that we're gonna do in a little bit. All right. And the next item is the requirements for cost of business meals deductions. So there's several requirements, right, in order for the business meal to be deductible, right? So the meals need to be ordinary and necessary. The amount, the cost has to be reasonable. The taxpayers must present at the meal, right, with current or potential clients. And the meals must be purchased separately from other entertainment activities, right? Because as we know, entertainment activities expenditures are not deductible when it comes to treating clients, right? So only business meals, 50% of the business meals are deductible, right? So all right, and then the next item is I want you to know the difference between the objectives of tax accounting and financial reporting accounting, right? So as we know, for financial accounting, the purpose is to be informative to the users of the financial statements, right? So we can say the financial accounting is very conservative, meaning under this the financial reporting accounting regime wants to accelerate the recognition of expenses and costs and defer the recognition of income, right? So if there's a income, if there's expenses, or if there's a cost incurred, financial accounting want to recognize that very early, very fast, right? Because financial accounting wants to inform the investors, the regulators, the users, pretty much the users of the financial report, about the bad news that related to the firm, because usually managers of the firm want to hide the bad news, right, from the investors. So financial reporting want transparent about bad news, about expenses, about costs. That's why they want to accelerate the recognition of expenses and defer the recognition of income, right? So for tax accounting, the objective is totally opposite, right? It's 100% opposite. Right? So for tax accounting, we want to accelerate the recognition of income and defer the recognition of expenses and costs, right? Because the government want to make more revenue, with more tax revenues, right? So that's why they want to accelerate the recognition of income in order to charge more tax on it, right? So for this item, I just want to know the main difference in terms of objectives between tax and financial accounting. All right. And the next part, I want you to know how to calculate the initial basis, adjusted basis of an asset, and how to calculate the realized gain or loss when there's a sales or a disposition of an asset happens. So this should be pretty easy. By now, probably at this point in the course, probably you all should know how to do this. So yeah, but we're gonna have a practice problem in a little bit that kind of focus on this. Right. And then the next item I want you to know is to know the cost recovery methods, right? So pretty much there's three main methods: there are depreciation, there's amortization, there's depletion, right? Depreciation is used to recover the cost of tangible assets, right? So we have buildings, we have personal properties, right? Amortizations is a method to recover the cost of intangible assets, right? So we have patents, we have copyrights, we have customer lists, stuff like that, right? And that depletion is a method to recover the cost of natural resources, right? So yeah, I want you to know the differences, the main differences among the three, right? Obviously, it's which method apply to which type of asset, right? And of the three methods, I think we spend majority of time talk about depreciations. So all of these are covered in chapter 10, right? And by the way, the test going to be this exam is only cover chapter 9, 10, 11, right? So only 3 chapters. So the material is going to be less. It can be less compared to previous tests, right? But there's still multiple choice questions. But the area, the amount of material that you guys have to cover is going to be less. All right. So okay. So let's get back to depreciation. So remember, when we talk about depreciation, we talk about the makers, right? So makers tables pretty much is the system that we use to calculate the depreciation expense for tax purposes, right? So so that's very important, and I want you guys to know how to use the makers table to calculate the depreciation expense. So in order for us to use the makers table, we first need to identify whether or not an asset is a personal property or real property, right? Because personal and property and real property is going to have different set of makers tables that we're going to use, right? And the way we calculate depreciation is going to be different as well, right? So, and then once we identify the property type, we need to identify the depreciation recovery period. right? So remember, for personal properties, usually it's going to be 5 or 7 years, right? There's other stuff, but in this chapter I just want to keep it simple, and actually going to give you some 5 years and some 7 years properties, and some of you have told me that you have difficulty in telling the difference between 5 years and 7 years, so don't worry about that. I'm going to tell you in the test which property is 5 years, which property is 7 years, so you guys don't have to memorize that, right? Alright, so yeah, and then after you identify the depreciation and recovery period, then now you have to identify the depreciation convention, right? Remember the half-year convention, the mid-quarter convention, the mid-month convention, right? So in the exam, since some of you having confusion about using about selecting the convention, so I'm just going to tell you guys right now that I'm going to ask you about the half year and the mid-quarter convention, so that's the true convention I'm going to ask you, so basically the question on the exam is going to be focusing on the depreciation of personal properties, right? Which there's two convention for depreciation of personal properties, so half-year convention and mid-quarter conventions, right? So I just want to keep it simple like that, and we're gonna talk about that when we do the practice problems in a little bit. So yeah, so I'm telling you right now that I just want to keep it simple, and the question is going to be focusing on half-year and mid-quarter convention, so those are the only two conventions that you will see on the test, right? But still, you have to be able to know when you use the half-year convention and when you use the mid-quarter convention, right? So yeah, but we're gonna practice in a little bit, so I hope that will help you guys a little bit. Alright, so and then in chapter 10 we also talk about section 179, immediate expensing, and how the phase out requirement apply to this section 179. So I'm not going to ask problems, calculation problems about section 179. I just want you to know the basic, the concept of section 179 in the expensing, as well as how's the phase out requirement applied to this section 179 requirement. So it's going to be just conceptual questions. All right, but you should know about the concept, what it is and how can we use it, how can we phase out, how does the phase out requirement affect the application of section 179 immediate expensing, right? All right, and next I want you to know how to calculate the depletion expense using cost depletion method and percentage depletion method, right? So as you remember, the calculation of depletion expenses are pretty basic, pretty simple, right? And we're gonna have a practice problem in a little bit as well, but pretty much I just want you to know how to calculate, how to apply these two methods, cost depletion method and percentage depletion method to calculate the expenses. But it should not be that bad, it should be quite simple, right? And then I also want you to know about the definition of luxury car, tax definition of luxury cars. So we know the tax treatment, the depreciation expense is going to be different based on depending on the type of cars, right? So for tax purpose, that's a definition for luxurious cars. So I want you to know that and pretty much I think I will give you a list of cars, and then I want you to judge which car can be considered as a luxury car, pretty much, right? And then I want you to know the different type of assets. So we know in chapter 11 we talk about ordinary asset, capital assets, section 1231 assets, right? And under section 1231 assets, there are three subtypes, right? So there are three subsections of assets, right? So we have pure section 1231 asset, which is land, right? Land. And then we have section 1245 asset, which is pretty much personal properties, right? And then we have section 1250 asset, which is the real estate, right? Like buildings, warehouse, that kind of stuff, right? So I want you to know the differences among these three, and also the main reason we need to differentiate this is to know how to do the depreciation recaptures, right? So I know in chapter 11 we talk a lot about how to do the depreciation recaptures for different type of assets, but for this exam I will just ask you to do section 1245 depreciation recapture problems, So pretty much this depreciation recapture for the sales of personal properties, right? And remember, there's three scenarios in the lectures that we covered, right? So I will ask you some question about those scenarios. I want to ask you how, to calculate how much of the gain or the loss, how much of the gain is recaptures. How much can be treated as section 1231 assets, So we're going to talk about that in a bit as well, because I prepared some problems for you guys. Alright, and then we talked about boot, right? So boot exists in a like-kind exchange, right? So we know in a like-kind exchange, in a pure like-kind exchange, one taxpayer are going to exchange his land to receive another taxpayer's piece of land, right? So pretty much they're just exchanging each other's land, right? And in like kind of exchanges, mostly purely apply to land, right? To real estate, pretty much, right? So in a pure like kind of exchange, there's no other thing involved, or two people just exchanging land to each other, right? But so in those cases, the value of land, the value of the properties need to be equal, right? So that they're just exchanging hand on the land, right? But in the case where the value of one property is less than another properties, right? So one of the taxpayers have to throw in something to make it an equal trade, right? Because one piece of land is worth less than another, right? So that's why the owner of that piece of land had to throw in something, right? So it can be cash, it can be some other personal properties, it's a piece of machines, a car, anything, So I want you to know what's the definition of boot, and what can be considered as boot, and what to do, how can we recognize gain when that's boot, pretty much. All right, and then finally, I want you to know how do we recognize gains in the sales of a property to a related person. Bring on sales to a related person. So we didn't really talk much about this, but I just want you to know the basic. What do we do with the gain when we sell a piece of properties to a related person? Do we treat do we recognize the gain as ordinary income, or do we recognize the gain as capital gain? So just those basic stuff. So that's pretty much it in terms of the topics that I want you to pay attention to. And because this exam only covers chapter 9, 10, and 11, so as you can see, the material, the amount of materials is a little bit less than compared to last time. So I hope that's gonna help you guys prepare better. But now you have more time to cover less materials. All right. So if you have any question about any of this, just let me know. Just email me. All right. So now let's look at the practice problems. So I prepare nine problems here. So let's go through each of them. All right. So let's look at problem number 1. So we say Donald owns a business that employs his son Joe, and Joe is paid $60,000 per year by Donald's business. In comparison, other employees with Joe's responsibilities are only paid $50,000 per year. What is Donald's business deduction for employing Joe? Right. So this is a question about the reasonable amount of expenses, right? So in this case, we know that Donald pays other people with the same responsibility as his son $50,000, but for his son he pays $60,000, right? So obviously the $60,000 is not reasonable amount, right? Because other people only make $50,000, right? So that's why Donald can only deduct $50,000 of compensation expense when he paid his son, right? And then the remaining $10,000 has to be treated as some sort of gift to his son, right? It cannot be treated as a compensation, because the compensation expense reasonable amount is only $57, right? All right. So this is pretty easy, right? Pretty straightforward. All right. So let's look at problem number 2. So it said, Ken borrow $100,000 from a bank to buy City of New York bonds, and this year Ken paid $2,000 of interest on borrowed funds. How much of the interest expense can Ken deduct, right? So in this case, this guy Ken, he's borrowing money from the bank to buy a municipal bond, right? The City of New York bonds. So because we know municipal bond is a tax exempt investment rate, so the interest, the expenses incurred related to tax exempt income is not deductible, right? So even though Ken still pay $2,000 of interest on the borrowing fund, he cannot deduct anything, right? He cannot deduct any of this amount. All right, so the answer is going to be 0, right? All right, so let's look at that problem number 3. So it said Mary paid the following to attend a business meeting, right? So we have airfare $800, hotel for 3 nights $600. So this girl, this lady, she stays there for 3 days, right? And meals for 3 days $270 with on average $90 a day, right? So the question asks, what amounts are deductible if Mary spent 2 days out of the 3 days in meeting, right? So we know that this is the primary business purpose trip, right? Because she spent 2 out of 3 days to engage in the activities, the business activities, right? So because of that, 100% of the airfare is going to be deductible, right? So all of the 800 is going to be deductible, right? And then in terms of lodging, she stay so 3 nights $600, but she only stayed two days, only spent 2 days in meetings, right? In business meetings. So that means you can only deduct the lodging for 2 nights, right? So it's going to be 2 out of 3 times 600. It's going to be $400, right? And in terms of meals, because only business meals are deductible, right? So in this case, this lady, she spent 2 days out of 3 days to do business. So that means only the meals expense of 2 days are deductible, right? So the expense of meal for 2 days are 2 over 3 times 270 is going to be $180, right? But then only 50% of the cost of the meals, of business meal, are deductible, right? So we have to times that by half as well. So we have 270 times 2 over 3, and then times 50%. Right, so that's when it comes to $90, right? So in total, it's going to be $1,290. So that's going to be the total expense that Mary can deduct for this business trip, right? So I hope that is clear. So let's go to problem number 4. So in this problem, it asks ABC company purchased an old office building for $200,000 for use in expanding its current operations. An additional $50,000 was spent painting and remodeling the building in preparation for its opening. And then every 6 months, the company pays $1,000 to have the windows cleaned. What is the initial basis of the building? Right. So we know this is a question related to initial basis of an asset, right? So we know the basis of an asset includes the initial amount that the taxpayer spent to acquire the asset, right? And then the basis also includes additional expenditures that spent to either improve the assets, restore the assets, make the asset better, or make the asset fit to the purpose of the business, right? So in this case, we know for sure the basis is gonna include the $200,000 initially the company spent to acquire the building, right? And then the basis should also include $50,000, right? Because this $50,000 is spent on remodeling the building to fit the business purpose, right? And then for the $1,000, what do we do with it? So because $1,000 is not, it is just a maintenance, it can be considered as a maintenance activities. So we know the basis of asset cannot include maintenance, service kind of expenditures, right? So $1,000 we cannot include in the initial basis for the building. So the initial basis for the building is going to be $200,000 plus $50,000 plus $50,000. All right, and that comes out to $50,000. All right. So last problem number 4. Let's go to the problem number 5. So in problem number 5, it says Santa Fe purchased the right to extract turquoise on a tract of land over a 5-year period, and Santa Fe paid $300,000 for extraction rights. And a geologist estimates that Santa Fe will recover 5,000 pounds of turquoise. During the current year, Santa Fe extracted 1,500 pounds of turquoise, which is sold for $200,000. So the question asks, what is Santa Fe's cost depletion deduction for the current year? Right. So this is the cost depletion problems. Right. So we're going to use the cost depletion method to calculate this problems based on the material that they give us. Right. So we know $200,000 is the amount, is the basis of this piece of land, right? Of this mine, right? And the reserve of resources for this land, in this piece of land, is 5,000 pounds of turquoise, right? So with that, we can calculate the per unit depletion, right? Because we have the basis of the whole mine, and we have the total reserve, right? So first, let's say units depletion cost. So it's going to be $300,000. $300,000 divided by $5,000, 5,000 pounds, right? So that will be That will be $60. That will be $60. So $60 per pound. Right. So now we have the unit depletion cost. We can, and then we know that in the first year, in the current year, the company tried 1,500 pounds. Right. So now we can see the depletion, the total depletion deduction is going to be $60 pound 1,500. Right. Will be $90,000. So $90,000 is going to be the depletion deduction for this company, right, in this current year. All right. So see, it's pretty straightforward, pretty easy. Only 2 steps, right? So that's problem number 5. Let's look at problem number 6. So in this problem, it says in year 0, ABC company purchased a machine for $80,000 to use in its business. In year 3, the company sold the machine for $55,000. Between the date of the purchase and the date of the sale, the company depreciated the machine by $30,000. So the question asks, what is the amount and the character of the gain or loss ABC will recognize on the sale? Right, so this problem, it is depreciation recaptures problems, right? So we have a disposition of a piece of machine, and we know the basis, we know the price, the proceeds that the firm get from selling the machine, and we also know the depreciation amount. Right. So first of all, we have to find out how much gain or how much loss this company get from selling this machine. Right. So we know that the initial basis was $80,000, right? And we also know the accumulated depreciation is $30,000. Right. So with that, we can calculate the adjusted basis for the machine, right, as of the time of the sale. Right. So we know the adjusted basis is going to be $80,000 subtract $30,000. That equals $50,000. Right. So $50,000 is going to be the adjusted basis. Right. And then we know the machine is sold for $55,000. So now we know it's going to be a gain, right? So this gain is going to be $55,000 subtract $50,000. Subtract $50,000, and it's going to be it's going to be $5,000. Sorry, $5,000. All right. So the gain now is $5,000. So now what we do, we compare the gain and the depreciation amount, right? So compare gain with depreciation amount, accumulated depreciation. Right. So we know it's $5,000, so it's definitely smaller than the $30,000. Right. So under the depreciation recapture rule for section 1245, under section 1245, right? So we know section 1245 is pretty much personal asset, right? So in this case, the piece of machine that is personal properties, right? So so for under the depreciation recapture rule, it says the extent of gain that is generated by depreciation have to be recaptured, have to be treated as ordinary income, right? And if there's any remaining kind of gain, then you can treat the remaining gain as section 1231 gain, which is pretty much a long-term capital gain, and it's going to be taxed at a preferential rate, right? So in this case, because the gain, definitely the gain itself is generated by the depreciation amount, right? Because the gain is way smaller than the depreciation amount, right? So that's why we use that's why the total amount of $5,000, the total amount of gain here, it has to be treated as ordinary gain, right? So let's see, if we, I think it should be chapter 11. Right. If we look at the chart, I think there's a chart in chapter 11 that kind of captures the whole basic concept of depreciation recaptures, right? All right, this chart, right? So if the gain, right? So if the gain is smaller than the depreciation amount, right? So you can see the pink section here is the amount of depreciation, right? The blue is adjusted basis. So here the gain, if you have some gain, right? So the gain, if the gain is still smaller than the depreciation, then we have to recapture the whole amount of session of the gain as ordinary income, right? But if the gain exceeds the depreciation rate, if the gain is bigger than the depreciation amount, then the extent that equal to the depreciation is going to be taxed as ordinary income, and then the remaining is going to be taxed as section 1231 gain, right, which is going to be taxed at preferential rate, right? So in this case, our case is this column, right? Our gain here is smaller than the depreciation amount, right? So that's why we have to treat the whole amount as ordinary gain, right? All right. So the whole amount of $5,000 is going to be treated as ordinary gain under section 1235. Alright, so that was problem number 6. Let's look at problem number 7. So problem number 7, everything is the same except for the revenue, right? The proceed that the firm received from selling this machine, right? So we still know the initial basis was $80,000. We still know the accumulated depreciation was $30,000, right? So now from there we still know the adjusted basis is still going to be $50,000, right? So $50,000 of adjusted basis, right? And then now we calculate the gain. So the gain now is going to be $85,000. $85,000 subtract $50,000. Is that going to give us $35,000? So now we compare with the accumulated depreciation, right? So now we know $35,000. 35,000 is greater than $30,000. Right. So now in this case, we are facing this scenario right here, right? So the gain, the total amount of gain is greater than the depreciation, right? So the extent of the gain that equal to the depreciation is going to be treated as ordinary income, and then the remaining is going to be treated as section 1231 gain, right? So now we know $30,000 is going to be treated as ordinary gain under section 1245, and then the remaining $5,000 is going to be treated as section 1231 gain, right? So it's going to be taxed at preferential rate. Alright, so yeah, so in the test, I think I'm just gonna ask you about these two scenarios, so if you understand and you know how to do this two problem, then you should be fine with the problems I ask in the test. Alright, so now let's look at problem 8 and problem 9. So problem 8 and problem 9 are problems about calculating the depreciation expense, right? And in this case, we have to use the maker's tables to calculate the depreciation expense, right? So since some of you asked me about this, I want you to talk about this a little bit, and hopefully you guys understand what I'm trying to convey. It should not be that bad if you are practice often. You should be able to grasp the idea, right? So so let's look at problem number 8. Right? So we see ABC company purchased 2 assets during the current year, and they use the full month tax year, full 12 months, right? So calendar year. So we say on April 20th, ABC company placed in service computer equipment, which is a 5-year property, with a basis of $50,000, and then on November 16th, the company placed in service a piece of furniture, which is a 7-year property, and with a basis of $8,000. Right. So most of these properties are personal properties, right? And I told you that in the exam, I just gonna ask you about personal properties, right? So so we know for sure in this case we have to use the half-year convention or the mid-quarter convention, right? So how do we select whether we should select half-year convention or whether we should select mid-quarter convention? So let's start at the timeline here, right? So under the rule, right, under the maker's rule, we know if the total amount of assets that is placed in the fourth quarter is equal or more than 40% of total assets placed in service in the year, during the year, then we have to use the mid-quarter convention, right? If not, then we use the half-year convention, right? So first, let's see. Say asset placed in fourth quarter. So we have to calculate this to be able to judge whether or not we use half-year convention or mid-quarter convention, right? So in this case, we know that the firm put in service the furniture, right? So which is $8,000. So $8,000 divided by the total amount of assets that placed in service, right? Which is $50,000 plus $15,000 plus $8,000 which is $23,000, right? So 8 divided by 23, how much is that? 8 divided by 23, that's 34.78%. 34.78%, right? So now we know that the amount of assets placed in fourth quarter is less than 40%, right? 40% of the total amount of asset that is placed in service during the year, right? So that's why we're going to use the half-year convention, right? If this amount right here is say 45% or anywhere above 40%, then we have to use the mid-quarter convention. Other than that, if it is smaller than 40%, we use the half-year convention, right? So this is how you select the convention, right? So with that, now we can calculate the depreciation expense for each of the asset, right? So let's start with the computer, right? So the computer, right? So now how do we do it, right? So now since we know that we're going to use a half-year convention, we're going to look at the makers table, right? So we look at here. So here we have the makers table for half-year convention, and we have maker table for mid-quarter convention right here, right? So but we're going to look at this table, right? The half-year convention, right? Because that is what we're going to use for this problems, right? So we know that the computer is a 5-year property, right? And then the question is asking the depreciation expense for the first year. So look at this 5-year column, 1-year line. So the percentage for the computer is going to be 20%, right? So we take $50,000 times 20%. How much is that? It should be like $3,000. Yes, $3,000. Right. So $3,000 is going to be the depreciation expense of the computer in the first year. Right. So now let's look at the furniture. Right. So we know the furniture is a 7-year property. Right. So now we look at the 7-year column and first year line. So the percentage for the furniture is going to be 14.29%. Right. So we take $8,000 times how much? 14.29%. 14.29%. And how much is that? $8,000 times 0.1429. That's going to give us $1,143.2. So in total it's going to be how much? In total it's going to be $4,143.2. Right. So this is going to be the total amount depreciation expense for most of the furnitures, for most of the assets, right, in the first year. All right. So the most important thing here is to identify the convention, right, and then go select the right table and then select the right percentage amount, right. So yeah, so that was problem 8. So let's look at problem 9. So in problem 9, everything similar except for the time, right. So now it says on November 16, the company placed into service the computer with a basis of $50,000, and on April 20th, they placed into service the furnitures with a basis of $8,000, right. So now let's look at how much asset placed in the fourth quarter. Right, so now we have $15,000, right? Because now they placed the computer. In November, right? In November. So $50,000 divided by 15,000. That's $8,000. Right? And how much do we have? Definitely it's going to be above 40%, right? So we have 15 divided by 23, going to be 65.22%. 65.22%. Right. So now, because the amount of asset placed in the fourth quarter is more than 40% of the total assets placed in service during the year, right? So that's why now we have to use the mid-quarter convention. All right. Pretty straightforward, right? So now let's calculate the depreciation expense for each of the items. So let's start with the computer. $50,000. Right. Now we have to go find the percentage, the depreciation percentage. Right. So let's look at the mid-quarter tables. Right. So the computer is placed into service in November, right, which is the fourth quarter. So we have to go find the table for the fourth quarter, right? So this is the table for the fourth quarter, right? Property placed in service during the fourth quarter. And the computer is a 5-year asset, and the first year is going to be, the first year percentage is going to be 5%. So 5% is going to be our percentage here, right? So $50,000 times 5%, and that's going to give us how much? That's going to give us $15,000 times 0.05. That's going to be $750. Alright, what about the furniture? So we know the initial base is $8,000. So now let's go find the percentage of the furniture, right? So we know the furniture is placed into service in April, right? So April is the second quarter, right? So we go to the table, find the second quarter. So this is the second quarter table, right? And we know the furniture is the 7-year properties, right? And we're trying to calculate expense, depreciation expense for the first year. So the percentage is going to be 17.85%, right? So go back here, 17.85%, and that's going to give us $8,000 times 0.1785. That's going to give us $1,428. $1,428. Alright, so in total we're going to have $2,178. $2,178. Alright, and that's it. Right, pretty basic, pretty simple, right? It's not that hard. The most important thing is to figure out the convention, right? And as you can see, it's not that hard as either, right? You just need to find out how much asset placed into service in the fourth quarter, right? Compared to the total amount of asset placed in service during the whole year. Right? And if that percentage is more than 40%, then you have to use the the mid-quarter convention. If not, you use the half-year convention, right? So yeah, so that's it. That's the end of that's all I have for the review sessions. If you have any questions, just let me know. Just email me. Again, the test is gonna be on Thursday, April 23rd, right? And the test technically starts at 1 p.m. right? And the test will cover chapter 9, 10, and 11, right? So only 3 chapters this time. So yeah, I hope you guys study well for the test, prepare well for the test, and let me know if you have any questions. I will send out an email. Oh, I forgot to mention, if you want to receive 3.8 extra credits, you can submit your work for the problems, for the practice problem right here, and I will prepare a link. I will create a link on Blackboard for you guys to submit the homework. I think it's easier for you guys to do it that way. All right, so oh, and I will send out an announcement about the test, like in the previous test now. So I think by far probably we are already familiar with the online setting, right? The online format of this class and the online setting of the exam. So last time it went pretty smoothly. So I hope this time it will go well as well. All right, so I'll see you guys in the next video. Take care and study well for the test.